Okay, it's time for Bullish Kevin. No, this isn't a flip-flop or capitulation. I'm still 2.9 on the bear bull scale. However, there are reasons to observe light at the end of the tunnel, and I'm going to start with a piece from UBS. This is just a short little preface, and then I want to look at the core problems with the economy, at least in the eyes of the Federal Reserve, as well as some tariff talk. So we'll talk about those three things briefly. UBS argues that while there has been negativity around AI chip deployment because of Microsoft's sort of rejiggering of data center leases and otherwise, the latest and most advanced chips are still the most cost-effective per query on the most complex artificial intelligence tasks. These tasks are tasks that really Blackwell-style chips, or the latest and greatest, excel in. And they actually are a thesis that UBS uses to argue the chip sector may actually, after this large discount it's just gone through, be relatively fairly valued and potentially overly sold. Now, they say neutrally valued right now, and I kind of agree with that. In fact, if I look at NVIDIA, I'm seeing it at a 1.2 peg. Not bad for the forward 12-month. If I look at AMD, it's even lower. It's ridiculous. It's shocking how inexpensive AMD is right now. You also sort of look at the chip sector as what it's done price action-wise. It's remarkable. I mean, AMD has been straight down since March of 2024. It's been literally a year of straight down and collapsing 50% in value. NVIDIA has peaked out roughly after the election here and right around Inauguration Day at 153. It's down a pretty good chunk since then. And there are plenty of other opportunities. I mean, 28% on NVIDIA, it's remarkable for a company that makes as much money as they do. Now, a company like Tesla is still relatively expensive, sitting at a 3 peg, but it's also come down substantially in valuation, and a lot of this valuation is representative of hope around robotaxis and frankly, artificial intelligence built into Optimus robots. So there are some really interesting opportunities, even in spaces like beauty, where things have actually gotten cheap. So it's sometimes easy to miss good opportunities because it's popular to be bearish and negative about the economy right now. So it's easy to sort of be blind to good opportunities, like the behemoth Rocket Mortgage is creating, or this potential sectoral bottom in Ulta. Not only Ulta with its partnership in beauty with Target, but the closing of Sephora stores because of their, incorporation into Kohl's, which is suffering. And Lauren actually had a really good point on the Sephora Kohl's partnership. She never really understood that partnership. Lauren's my wife, mind you, mother of my 7 kids. Ulta matches Target's demographic, and she sees an alignment with those brands. Whereas when you look at Sephora, owned by Berkshire Hathaway, in Kohl's, you're actually taking a more premium makeup brand and putting it into a lower income store. So you have a complete demographic mismatch. But Kohl's is shutting down stores because of their own failures, but it's taking down Sephora's with it, which actually creates less competition for Ulta. A very interesting sort of thesis. But my point is, there are actually opportunities popping up, and we're talking about these daily in the course member live stream. This morning, we were talking about various different companies where we're like, oh my gosh, absent the drama that's going on with tariffs, here's some really incredible value opportunities. We're growing our list daily where we're like, this is incredible. There are real stock market opportunities here. And should we not go into a recession, these are buying opportunities. Now, of course, you have to weigh those buying opportunities by your belief as to whether or not there's going to be a recession. And that's where this next part of the discussion regarding the Federal Reserve, I think, will help you. Now, keep in mind, when we talk about these numbers here with the Federal Reserve, I want you to know I'm open to working with you daily and working, like we work together on this in our course member live streams. We do over, 3,000 to 4,000 of you watch every single day. And if you're not part of it yet, check it out. Go to meetkevin.com. You could lock in the membership now because the price goes up on April 15th. That means if you lock in your subscription price now, you lock it in at less than whatever it is, $1.70 a day or whatever. You lock that in for life. If you cancel or you join later, that price could be significantly higher in the future. You get access to all the courses, private live streams, alpha report, every day the market's open, trade alerts. everything. Course member meetups. We got a course member marathon coming up. So it'll be really fun. So stay tuned and check that out. Go to meetkevin.com to sign up for that. But let's for right now talk for a moment about what the Federal Reserve pays attention to. So Austin Goolsbee told us that usually when the job market opens, or sort of, I shouldn't say opens, normalizes, it doesn't suddenly stop its decline. It just keeps descending until you're in a recessionary environment, which isn't great. However, if we look at the job openings chart with the latest JOLTS data that we got for February, still a little dated, it's from February, but still, plot this on a chart. Look at what's happened. This is very unusual. Rather than job openings continuing to plummet into recession, we've actually started to level off, which is weird because we're leveling off right at that 1.0 job openings to those unemployed. That is odd. Jerome Powell says the one saving grace we have in our economy right now is the fact that layoffs have not spiked yet, and that JOLTS data is leveling off. This is what Austin Goolsbee told us was unlikely to happen, but it is happening. Now, it's possible it could have started happening in October in anticipation of Trump, in November in excitement over Trump, and in December and January over excitement of Trump, and then a pull forward of tariffs, making businesses keep their employees because they're too busy. I know people who haven't bought a new car for 15 years. Tariffs pushed them over the edge. I'm going to buy a car because tariffs are going to make everything more expensive. You've actually had a fantastic coupon code expiration because of the tariff drama that has created a pull forward for a lot of fantastic businesses, keeping now their employees, building up inventory, and also pushing sales through. Best sales quarter in years for the automotive industry, not including Tesla, for a Q1. Absolutely fantastic sell-through. Now, this is fantastic for businesses. Uncertainty isn't, but uncertainty can wane rapidly. See, usually what happens with sort of the Trump drama is you buy the dip on this stuff. You buy the dip because generally Trump ends up coming out going, we were going to do 10%, 15%, 20% on different sectors and countries, but, then Canada folded. Just this morning, we already heard Canadian Premier Ford from the Ontario province suggest we're open to removing all tariffs, going to full free trade. I wholeheartedly, if there was a Kalshi chart, maybe there is, where I could just bet, will we be at free trade by the end of the decade? My answer would be 100% yes, and I would put money on it. Because really, either Donald Trump is going to bring us back to free trade, maybe even lower free trade, like more free trade, right? Because we weren't truly at 100% free trade. There were still some minor tariffs. Most countries had about 1.5% tariffs in aggregate on each other. So if we bring those net lower, then Trump actually declares victory. He brought us back to free trade. Now, the problem with that is the seductive nipple, if you will, of $600 billion of potential annual tax revenue is not going to work out anymore if we go right back to free trade, which is going to create some potential problems for, Trump's idea of collecting that $600 billion in revenue and removing taxes on those making under $150,000 a year. But most people didn't really find that to be highly reasonably realistic anyway, more of a sales pitch for Trump. So if we do return to free trade by the end of the decade, and we don't get a sort of ignition of the spilled gasoline that's in the economy right now via some form of shock, Black Monday, Lehman Brothers collapse, basis trade collapse, carry trade collapse, or some black swan we're not paying attention to, we're seeing right now, unless we have some form of a shock, the leveling that's happening right now in the labor market is fantastic, and it is actually plays right into what the Federal Reserve wants. Now, there's some implications for that. The implications are that maybe we're at a peak fear moment, or maybe we will be at peak fear over the next few days as there's a lot of volatility that comes from sort of tariff negotiations and counter tariffs. We'll see. We'll know that over the next month. But there are opportunities in the stock market, and the labor market so far is behaving the way the Federal Reserve wants, which is non-recessionary. Now, that doesn't mean it can't flip rapidly. The labor market lags, we know that. So I do think there's a time, we are in a time for caution, cautious optimism, and staying out of debt and diversification. But as we resolve these tariff issues, I actually think people are going to take the money that they started saving and start deploying it. You know, we're seeing people diversify and they're like, hey, I've got this bundle of cash right now. I'm going to put a little bit into house hack because you guys are doing the Reg A and you've got big things coming. Great. That's awesome. That's cool. Thank you for that. Go to househack.com, read about that if you want. You know, you get paid 5% upside protection. If our stock 10x's, you get the full 10x, baby. It's great. And you get downside protection. It's awesome. Like, and you're getting a 5% annual yield. I think it's a steal, and we're doing it because we want to take care of our course members first so that, knock on wood, we can do what we want to do and blow this company up over time. The course members are the ones who won the most before Wall Street got in and is like, oh, wow, what they're doing is actually really cool. Because, you know, that's when things become unaffordable. That's when things Newsmax, which, you know, we know that's way overvalued. We know that's a momentum play right now. There's a reason it's down 53% today, because the momentum is dying, which we also talked about in the Alpha Report this morning. Alpha Report this morning, I'm like, the momentum is over. Get out of Newsmax. 2 days ago, or was it yesterday morning, I'm like, today is a momentum day for Newsmax. Damn thing doubled up. That is in the Alpha Report. You can go fact check it. The course members are getting that every single day. If you're having an issue getting access to it, make sure you check out or just email us at staff@meetkevin.com if you have a problem, but you should have access to it. This morning I said, quote, you could fact check me on this. Newsmax momentum may be over today. It's 10x overvalued, so watch out below. Momentum over. So look at what's happened today. It's over. Over. Okay? You opened at 184. You had plenty of an opportunity to get out. It's halved because it was a momentum play. We all know that. That's fine. But it's the same thing we said in the Alpha Report about Tesla. If we break out of this 260 zone, we're probably going up to the 274 range, which we did. And we bounced there twice. And then, of course, we got the Elon Musk step down from Doge news, which has pushed us even further, which is remarkable for a day that Tesla sales missed, but we already knew that. The reason you get this sort of bounce is because we already knew about the bad sales data, and now it's over. The same thing could happen with the tariff news. Now, the big thing for me is threefold. One, look for great value, great deals. You know me, I'm a real estate wedge deal buyer. I like deals. I like deals in stocks too, even if they're patience plays. The jobs market, look at what's going on with layoffs and warn notices. This is an interesting one. We haven't talked about this yet in the video, but it's worth paying attention to. If you look at warn notices are a record low right now. Now, they're somewhat, if you annualize them out, warn notices are somewhat similar to where we have been in years before some of this recent, drama. Take a look at this chart right here. It looks really low right here, but you really have to annualize the 72 times 4, which puts you at about 288,000 layoffs. But that's really in line with 24. It's lower than 23. It's higher than 22, obviously. But it's in line with 2016, 17, 18, and 19. So you're really not seeing this sort of huge movement in layoffs. If you go to the layoff trackers as well, you're seeing the same thing with tech layoff trackers. We're just not seeing an explosion that you would expect to see in a recessionary environment in tech layoffs. Again, of course, we could see this moment of government workers, say 300,000 government workers get laid off, 2 extra non-government workers get laid off after those government workers get laid off, so you're at 900K unemployed. Sure, that's potentially going to lead to a 0.5% increase in the unemployment rate. But ironically, the lack of immigration coming in means you potentially have a smaller supply of workers anyway. And I'm not necessarily saying that immigrants were able to take the same jobs that could be impacted by the federal government. There's probably a mismatch there. But this idea that we definitely have to go through a layoff cycle, I don't know. I think there is the potential that artificial intelligence makes it really hard to get jobs back once we're in the next recession. We don't know when that's going to be. But it's also very possible that we're not actually going to see such substantial layoffs because of AI. People are just enhancing their productivity and the profits for the large companies they're working for with the artificial intelligence. The next recession will be painful for that, but not yet. So all of what I'm describing here gives me reason to be bullish and makes me very curious about buying the dip on especially certain sectors like the ones we've been talking about this morning in the course live. So join that if you haven't yet. I'd love to see you there. And folks, we're going to see you soon because we're going to keep bringing you updates. I'm glad to be back in the office here regularly. So thank you so much for being here, folks, and we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.